Great. Well, welcome everybody. Good morning. Glad to be back with you this morning. You know, the market's been very volatile over the last few months, and a lot of the questions I've been getting from members and followers is, you know, how do we reduce risk in this marketplace? And one of the most effective ways I find to reduce risk is with options. So I thought I'd talk to you a bit this morning about options, how simple they can be and how effective they can be. You know, once I learned how to trade with options, which was many, many years ago, I've never looked back. It is absolutely, in my opinion, the best way to trade. So that's what we're going to be talking about over the next 45 minutes. I am Vince Vora. I'm the head trader here at Trading Winds. I've been doing this for a little over 30 years. We've developed several of our own systems and strategies. But today I want to talk to you simply about options. And in the presentation today, I'm going to start with the basics, what a call is, what a put is, when and how you might want to use it. You'll be surprised at how much you can do with just calls and puts. We're going to talk a bit about who actually makes money in the options market. And then I'm going to share not one but two option strategies with you this morning. If you have questions, as Renee said, by all means, please ask. We do like questions, want this to be as interactive as possible. Don't hold back, ask throughout. I may wait until the end of a particular section to respond to your question, but if it's important for that particular segment that we're on, I'll pause and answer your question as best as I can. Please do remember that trading can be risky, so please don't trade with real money until you are completely comfortable with the system that you are using. So let's begin, and let's talk a bit about call options. So I'll give you the textbook definition of call options, and then, you know, I'll explain a bit more how we use them. And once I get to the charts, once I get to that part of the presentation, I'll bring up an option chain and go through the strategies with you in detail. So a call option gives you the right but not the obligation, and that's really the key here. You have the right but not the obligation to buy a specific amount of stock at a fixed price known as the strike price, anytime from when you buy that option contract until the expiration date. Okay, so here's a couple of key things about being a buyer of an option. Now, whether you are buying a call or whether you're buying a put really doesn't matter. The point is, if you are a buyer of an option contract, you are in control. In other words, you decide if and when you exercise that option. Okay, for the most part, people just trade option contracts. They rarely exercise them. They just trade them. But you decide. As a seller, otherwise known as a writer of an option contract, again, whether it's a call or a put, as the seller, you're at the mercy of the party on the other side of that transaction. In other words, you don't get to decide when and if that option gets exercised. You're at the mercy of someone else deciding that for you. So you should always be aware that there is that chance that you will get exercised. Now, we'll go through exactly what that means and how likely that is as we go through the presentation, okay? But if you're buying a long call, not only do you get to decide if and when you ever exercise that option, but the real benefit here is that not only is your profit potential unlimited, because the underlying security for that option has the ability to continue moving higher, right? Whether it's a stock, a futures contract, you know, sky's the limit. It can continue to run. And so you have unlimited profit. But the real benefit here is your potential loss, which is always limited to the premium that you pay for that call option, okay? So if you buy a call option for $150, that's all that you can ever lose, okay? And we'll go through specific examples, but not only do you have the right to exercise, and you decide when and if you exercise, but you can only ever lose what you pay for that option, okay? On the flip side, if you're short that call, or in other words, if you're a seller, first of all, your profit potential is limited to the premium that you receive for that call. So if you sold it for 150, that's as much as you can ever make on that trade. But your potential loss is basically unlimited, because again, the underlying stock price can continue to go against you. It can continue to go higher, right? When you're a seller of that option, you are hoping that the price goes down. So you sell it, say at $1.50, and as it goes down, you can buy it back at a much lower price. Same as shorting stock, okay? Now, put options are very similar to call options, except instead of giving you the right to buy, they're giving you the right to sell. Okay, so a put option gives you the right, but not the obligation, to sell a specific amount of stock at a fixed price known as the strike price, anytime from that date of purchase to the expiration date. Okay, the put option seller is obligated to buy that stock if the other party decides to exercise. Okay, so again, as a buyer of put options, you get to decide if and when you exercise, and your profit potential in this case is still substantial because it increases as that stock price moves its way down to zero. Okay, but it's not unlimited. It's only you know, as much as there is in the stock. In other words, if it's a $50 stock that you're buying, your maximum profit potential is that $50, because you know, it can't go any lower than zero. But your potential loss, similar to when you're buying a call, is limited to what you pay for that put. So you can never lose any more than what you pay for that put. So in an environment like this that's very volatile, you can control how much risk you take by the amount that you spend on an option contract. So you can define your risk level right from the very, very beginning of that trade. Okay? If you're going to sell put options, okay, and be short that put contract, then your profit potential is limited to the premium that you receive for that put, just like it was in the call example. And your potential loss is still substantial, because it will increase as the underlying stock price makes its way to zero. Okay? Now, what do we mean by options premium? Options premium is the price that you pay for that option contract, and this is how you calculate it. One option contract is the equivalent of 100 shares of underlying stock. Okay? So an example, if you're buying one call option, you would multiply the 1 times the 100, because it's the equivalent to 100 shares, times the price or the cost, which is 150. So in this case, 1 times 100 times $1.50 is $150. And again, if you're the buyer, whether this is a call or a put, that's the most you can ever lose. That is your worst case scenario. Okay. Now, what type of options can you buy? There are thousands, literally thousands of options out there on stocks, both with monthly, weekly expiries. There are options on stock indexes, they like similar to the S&P 500, the Qs for the NASDAQ 100. There's options on futures contracts like crude oil, gold, wheat, cocoa, you know, you name it, coffee. Just about anything out there these days has an option contract that you can trade. Okay? Now, there's a few terms that you need to be aware of, or should be aware of. In the money. What do we mean by an in the money option? This is, and I'll use calls as an example to begin with, a call option with a strike price that is below the market price of the stock. So if, for example, you had a stock that was trading at $25 a share, and you bought the call with the $15 strike, that means you are $10 in the money. You have the $15 strike, but the underlying stock is trading at 25. You're actually $10 below that current market price, so you're $10 in the money. Okay? For a put option, it's the opposite. Because you're looking to sell, being in the money means a put option with a strike that is above the current market price. Okay, so if you had a $35 put and the stock was trading at 25, again, you'd be $10 in the money that way. Excuse my dog, he's getting a little excited. here at the front door. My apologies. Now, another term is out of the money, which is the opposite. It's that difference. So if the call option strike price is actually higher than the current market price, that's the out of the money portion. And for the put option, if it's below that current market price, that's the out of the money portion. This will all become very clear when I bring up the option table and I can show you with specific examples, okay? The at the money strike is the strike price that is closest to the current market price for both calls and puts. Now, we have intrinsic value, we have extrinsic value, and we have implied volatility that you should also be aware of. Intrinsic value is what we call the in the money portion, okay? Usually an option contract or the premium that you pay for it is made up of both the in the money and the out of the money portion. The in the money portion is what we refer to as real value or intrinsic value. So again, if the stock price is at 25, but we have a strike price of 15, that means we have $10 of real value. Why? Because if we exercise and we purchase those shares at 15, we can turn around and flip them on the open market at 25. So we actually have $10 of real value, and that's what we call intrinsic value. Extrinsic value is the out of the money portion, otherwise known as time value. So the difference between an option's market price and its intrinsic value. So think of it this way. That $15 strike price, a strike call, depending on the amount of time to expiration, it'll be worth more than 15. It's automatically, worth more than 10. It's automatically worth 10 because the strike is 15 and the market price is 25. That's your $10 of real value. But say you had 2 months to expiration, this might be worth $17 or $18. Okay, that's 12 or $13. My apologies. That's $10 of real value plus $2 or $3 for time value or extrinsic value. Okay, and then implied volatility. This is important, and it'll become more important over the next few slides. It's the measure of how volatile that underlying stock may be, okay? Not the actual option contract, but the underlying stock. So generally, when things are going higher, when stock prices are moving higher, there's very low volatility, and that's because no one's concerned, everyone's happy, the price is going higher, and it usually does slow, so in a slow and steady fashion. But when stocks sell off, that's when investors and traders get very nervous, and you get that panic happening, and to sell off much more rapidly than they go up during a bull market, okay? And that's when you see that implied volatility spike. When prices are selling off and people get worried, that's when you see more volatility, okay? Just like we saw at the end of January into early February, that swift move lower, and ever since we've had a lot more volatility, okay? Now, let's look at some facts. First of all, option contracts are only risky if you don't know how to trade them. If you listen to the media, you're going to hear a lot about how risky options are and how you should, why you should stay away from them. I'm going to show you in a second why they are much, much safer than just trading stock. Okay, but the key is to understand them fully. Now, another fact, this isn't a myth, this is actual fact, over 80% of all option contracts expire worthless. Okay, we're going to come back to this point in a little while. It's very important. Okay, and another fact is that most people buy option contracts, but they do so without taking fair value or that implied volatility component into consideration. So what ends up happening is they end up buying overpriced options, and they lose money even though the underlying stock did move in the direction that they thought it would. And this is why there's that myth around options about them being as risky as they are. okay? But it's a myth. And it is because most people lose money trading options, but it's for this exact reason. They end up overpaying for them to begin with, and even though they're right on the direction of the stock, they end up losing money. So let me paint the picture for you this way, okay? Whenever you're buying an option, and whether you're buying it or selling it, as far as the underlying stock is concerned, there are only 5 potential scenarios, okay, ever. No matter what, there are only these 5 scenarios. One is that the stock moves in your favor big time, okay? You get a nice strong move in the direction you thought it was going to go. 2, it moves slightly in your favor. 3, the stock does nothing. It just kind of consolidates sideways. 4, it goes against you slightly. Or 5, it goes against you big time. Those are the only 5 possibilities ever for an underlying stock. Whether it's a stock or a futures contract, doesn't matter. Those are the only 5 possibilities. But when you're buying an option, if the stock moves in your favor big time, of course you're going to make money. You should make good money. If it moves in your favor slightly, you may make money. And here's where the question mark comes in. That implied volatility component and fair value component, that's what makes the difference here. If you understand the implied volatility component and fair value component and pay a reasonable price, a fair price for that option, and it moves slightly in your favor, you will make money. But if you overpay for that option contract to begin with, even though it moves in your favor slightly, you're still going to lose money, okay? And that's why for most option traders, they will still lose money if it moves in their favor slightly. If it goes flat and does nothing to move sideways, they will lose money. And that's because of that time value component, the extrinsic value. As we get closer and closer to expiration date, that time value component erodes. It slowly goes down to 0. So even though the stock does nothing, it doesn't go against you, it just stays flat, you're going to lose money on that option because you're losing the time value portion of that premium. If it moves slightly against you, you're going to definitely lose money. And if it goes against you big time, you'll lose most of your money there. So, you know, at best, when you're buying options, you have a 2 out of 5 chance of making money. But for most people, because they don't truly understand that implied volatility and fair value component, they end up making money only 1 out of 5 times. And this is why most option contracts expire worthless, okay, over 80% of them. So you're really looking at about a 20% opportunity here to make money. If you know what you're doing, more than that. Now, selling options, the same 5 scenarios can happen. Nothing else, the same 5. But this time, if you sold an option and the stock moves in your favor big time, you're going to make money. If it moves in your favor slightly, you're going to make money. If it does nothing and goes sideways, you're still going to make money. And that's because now that time value erosion works in your favor. You want your option to expire worthless because you sold it. It's like selling short a stock, right? If you sell at 25 and it goes down to 20, you can buy it back at 20 and make a $5 profit. Well, if you sold your option for $1.50 and it slowly erodes, right, it goes down to $1, you just made a 50-cent profit. So even if the stock doesn't move, you make money. Even if it moves slightly against you, you're still going to make money for that same reason. That time value component will erode, still giving you a slight profit. If it moves against you big time, that is when you're going to lose money. So as a buyer of options, remember, you have about a 20% chance of making money. If you truly understand how to trade options, it's more than that. When you're selling here, you have about an 80% chance of making money, 4 out of 5. And that, again, that's because over 80% of contracts expire worthless, okay? Now, here's the difference. Before you get too excited and think that, well, you should only ever sell options, because many people do believe in that. Here's the thing. When you're selling options, remember your profit potential is limited to the premium that you receive. So if you sold it for $1.50, that's as much profit as you will ever make on that trade. So although you have a very high probability of making money on that option contract, the amount of profit you can make is very limited, okay? For when you're a buyer, it's the opposite. Your probability is much lower of making money on that trade, but your profit potential is basically unlimited, okay? So where the difference is when you really understand options and know how to trade them, then sky's the limit. If you don't, then you're more than likely to lose money on it, which is why that myth is out there that they're that risky, okay? Now, when it comes to that time value component, this is sort of the progression of the time decay, okay? That erosion I was talking about. So what I want you to take away from this chart here is that if you're a buyer of options, you want as much time to expiration as possible. And if you're a seller of options, you want 30, maximum 40 days to expiration, no longer than that. The least amount of time to expiration, the better. Here's why. If you look at down here, we have 120 days to expiration. Going from 120 to 90, that's 1 month, 30 days. Look at the gradual slope for the time value erosion. In other words, it loses very little of value over those 30 days, right? Over the next 30, it loses a bit more. Over the next 30, it loses a bit more. In the final 30 days, it loses the remaining portion, which is the bulk of it. That decline accelerates rapidly into those last 30 days. So that's why as an option seller, when you're collecting that premium and you want that option to expire worthless, you want to buy you want to sell an option with no more than 30, maybe 40 days to expiration, so that that time decay happens rapidly in your favor. If you're an option buyer, you want that erosion to happen as slow as possible, because if you buy that option and your stock, just goes flat for a little while, you won't be losing that much money, okay? So that's what I want you to take away from that. Now, there are literally dozens of option strategies out there, okay? Today, we're going to focus on long calls and puts. We're going to talk a bit about protective puts. But, you can get into calendars, straddles, collars, butterfly spreads. These are all a little more complicated. We're not going to touch on today, but I will at the end of the presentation today talk about how you can get some more information on these. The key, regardless of which strategy you're trading, is to understand when and how to use it, okay? That's the key. So I always say you don't need to trade them all. You just need to focus on the ones that make you money. And what I mean by that is take it one step at a time. Learn calls and puts. And when you really understand them and are very comfortable trading them, then go to the next strategy and then the next and so on. Don't try to cover all bases, because you are just going to lose money, plain and simple. Learn one and then go from there. So let's talk about the strategies. Now, let's talk about trading Starbucks for less than a cup of coffee. And really, I'm only using Starbucks, just to, as an example. It could be anything. You can trade a very, very inexpensive option on just about anything. Let me bring up my charts and show you exactly what I mean. So here's the chart of Starbucks. Now, this is a monthly chart. Lately, it's been all chop, all just kind of going sideways. But let's for a minute assume that we believe that Starbucks is going higher from here, okay? So we want to buy a call option, okay? We actually have a choice. We can buy the stock, because if the stock goes up and we buy the stock, we're going to make money, right? But here's the difference. It's trading at $56.96. We'll call it $57 for easy math. If we buy 100 shares of Starbucks at $57, we need to spend or invest $5,700. And that is all at risk, okay? There is no protection there. So, we can say, well, it's highly unlikely that it's going to go down from here or it's going to go to zero. But you never know when there's some negative news story or anything. This can gap against you. It can drop rapidly, and your full $5,700 are at risk. Now, what if you only have an account of $1,000, $2,000? There's no way you're buying 100 shares. You buy a lot less, but it's going to be very difficult to make any money that way. Now, on the flip side, if we look at the option chain here, what you're looking at is all these different months here, and the number in the brackets are the number of days to expiration. So we start off with, the May 18 here, which is expiring today. Then next week, 7, the next week after that, 14 days, etc. All the way out to about 2 years. And any option contract that is more than a year away from expiring, that's what we call leaps. Okay, we'll touch on those a little later. But let's say we wanted to buy a call option. We want to give ourselves, a good amount of time. So I'm going to go out to September here, where we'll have 126 days to expiration. Now, instead of buying the stock at $5,700 here for $5,700, I can look at a call option. And I think that Starbucks has a good chance of going above $60 a share. It's already at 57. So I'm going to look at the $60 strike here. It's currently trading from $1.22 to $1.27, right? So if I were to buy one contract, which is the equivalent of 100 shares, that one contract would give me the right, but not the obligation, but the right to buy 100 shares of Starbucks at $60, right, on or before expiration, which would happen the third Friday of September, or 126 days from now. So that one contract times 100 times $1.28, right? That's $128. That's all I'm investing, okay, is $128. So let's compare it. I spend $5,700 to buy the stock. Now, if Starbucks goes up $1, I'm going to make $100 on that trade. $100 return on a $5,700 investment. If I buy the $60 call contract for September at $1.28, I'm spending $128. Now, if the stock goes up $1, I'm not going to make $100 on that trade. The delta here, and I'm not going to go too far into this explanation, but the delta, which you see here at 32 cents, this is a measure of how much your option contract will appreciate or depreciate on, depending whether the stock moves up $1 or down $1. So if it moved up $1, I'm going to end up making 32 cents. In other words, this option contract is going to increase by approximately 32 cents. So making, a $32 profit on $128 investment compared to $100 on $5,700 is a big difference, mainly because of that risk component. Not only is it a better percentage return, regardless, putting that aside, here, buying just the stock, I'm exposed on $5,700. That's what's at risk. Here, I can only ever lose 128. So, if God forbid we have another 9/11 type event and the market gets cut in half, all I'm going to lose is $128 maximum, compared to a lot more if I'm just owning stock. So that's one advantage. Okay. Now, with every dollar that Starbucks goes higher, the delta increases. So I may only make 32 cents on the first dollar, but then I'll probably make 40 on the next, 45, and etc. So the more it goes up, the more profit I'm going to make. Now, this is an example of an out-of-the-money option, right? An in-the-money call option is what you see shaded in yellow. The strike prices that are below the current market price, okay? Now, there's another way of doing this. We always like to say that options give us options, plenty of options. So trading the stock in combination with an option actually gives us more flexibility. So if any of you have a larger account and you can afford to buy the stock along with an option, here are the advantages. I can buy the 100 shares of Starbucks at 57. And then I can go out here and buy the $60 put at $4, okay? 405, 410, 415, in that range for protection. And this is how it would work. I buy the stock at 57 plus the $4 here, okay? That's 61, we'll call it about 61.20 or so in total, okay? That's my total cost, my total investment, 61.20, the stock plus the option. But that put option is giving me the right, not the obligation, but the right to sell my shares at $60 anytime between now and expiration, which is 126 days from now. So the only risk I really have on is the difference from 61.20 to 60, or roughly $1.20. Okay, so my risk component is basically the same as just buying a straight call. Okay, the difference is in the flexibility, because if this starts to go down, you notice how the put already has a delta of 70. So my net delta is 30 because the stock has 100 and the put has 70. The difference is 30, very similar to the call delta. So if the stock goes up, I'm going to make about as much profit as I would have on the call anyway. If it goes down, if it went down, I would start losing on my call, and there'd be nothing to stop that, right? Here, if it goes against me, again, no matter how far it goes against me, I can exercise at 60 and get rid of it, right? But if it goes in my favor, I can at some point roll up this put, okay, and lock in more profit, okay? So let's use the example of, if we wanted to roll these out now, let's say we had bought these earlier, okay? They were trading slightly more expensive. The stock moved up. Now they're a little less. They're trading at 4, but I want to roll up. If I go from 4 here, from the 60 to 62.5, okay? What's it costing me? It's costing me roughly about an extra $2, okay? Maybe $1.85 or so, but we'll say $2 it's going to cost me to roll up. But what's the difference? I rolled up 2.5 in strike, right? So if I sell this for 4 and pay 6, I'm adding $2 to my overall cost. But the strike price that I can exercise at has gone up 2.5. So I've automatically locked in another half a dollar of profit. Okay, and you can continue doing that along the way. The other advantage is, as the stock moves higher, these call options will increase in value. Okay, so these options at 62.5 and 65, they will start trading higher and higher as the stock goes up. And at some point, you can sell that contract against the stock. You can sell a covered call against the stock and bring in more premium. You lower your cost basis on the overall trade. You're bringing in more premium, and you're locking in a higher profit on your put. So as the stock moves in your favor, you're actually taking less and less risk, and you get to the point where you have actually zero risk and only profit that you continue to lock in, okay? And you can continue doing that. So having the stock with the put gives you more flexibility compared to just owning the stock, the call. But the real beauty of options in general, which is the reason why I decided to do this today, is to show you that you can trade with a lot less risk and a much smaller account just with options, without limiting your profit, without capping your profit, okay? Now, how many of you trade earnings or have traded earnings in the past or around earnings? Because that's the next strategy I want to share with you, okay? How many of you have bought an option contract the day before earnings, or if earnings was being released after market the day of, hoping for a big gap in your favor and making a lot of money, and then the stock does gap in your favor, but you realize, hey, I actually didn't make any money. Well, why is that? Well, here's why. That implied volatility component that we talked about at the very beginning, right? If you buy an overpriced option, there's no way you're going to make money on it. And here's why. You see these percentages on the right side of the screen here? Every expiration month has a percentage. That's the implied volatility. But every stock has a range, more or less. So for Starbucks, you know, it's in the high teens on average. Okay. Now, as you get closer and closer to an event like an earnings announcement, you'll get a spike in implied volatility. In other words, in anticipation of that event, these become more and more expensive. So let me show you an example. Macy's recently announced earnings. Let's go to the chart here. Go back to the daily. So earnings were the 16th, I believe. Yes, the 16th before market open. Okay, so on Thinkorswim here, we can go back. So let's go back to the 15th here, and you can see here's the implied volatility numbers. Now, for Macy's, it's basically around, you know, mid 40s to low 50s. So we'll say 50% on average is the amount for their implied volatility, their average implied volatility. If you can see that this week's expiration, the day before earnings was at 109.52%, okay? So basically 60% higher than the average. So the reason why buying that contract the day before and trying to sell it the day after doesn't work is because as soon as that announcement is made, as soon as those earnings are released, this will fall back in line with that average implied volatility. In other words, your option contract is going to lose about 60% of its value immediately. So what you need to make money is an enormous gap, a much bigger than usual gap in your favor to make money, because you overpaid by about 60%. And watch what happens the next day after earnings are announced. Boom, it falls right back in line, right? It's now at 52%. So it literally lost about 60% automatically, right? So it doesn't matter whether the stock gapped or not, your chances of making money on that option are very slim. And in fact, in most cases, you'll lose all of it, okay? I can show you another example. Let's look at NVIDIA. NVIDIA announced last week, I believe. Let's go back, look at the chart. They announced on the 10th, after market close, okay? So actually, let's look at the 10th. Let's go back here. Go back to the 10th and see where they were at before they announced. There it is. So you can see on average, you know, about high 30s, low 40s, right? Call it 40% is their average, but it was at 121. That's an 80% difference, right? So you're overpaying by 80% if you buy that. And the day after on the 11th, gone, right? It's gone. So that's the difference. So what you really want to do is mark that earnings date and start looking at the stock 2 to 3 weeks before earnings and look for a proper setup. With whatever strategy you're using, look for a reason to get in 2 to 3 weeks before, because the difference is this: as you move throughout those 2 to 3 weeks into that earnings date, that implied volatility number goes higher and higher and higher, making that option more and more expensive. So if you were to buy a call option here, even if the stock went flat, you would make good money on that option contract. I mean, look at the example here with NVIDIA recently. It went up 80%. That premium went up 80%. Yeah, okay. Even if the stock hadn't moved, just in anticipation of earnings. But if also you get a big move in your favor at that time, you're going to make even more money. The real advantage is that if the stock just went flat, you'd still make money on it. And even if it went against you slightly throughout that time, because of the implied volatility spike, you'd probably still make money, or at least you lose a lot less money. So it's so much safer to trade 2 to 3 weeks into earnings and be out of that trade before that earnings date, okay, that earnings announcement. So what you want to do is buy 2 or 3 weeks before and sell the day before, rather than buying the day before and looking for a big gap in your favor, okay? And remember, as a buyer, you get to control whether you exercise or not, and your profit is unlimited, but you can never lose any more than what you pay for that option. So you control the amount of risk you take in the market. And by doing something like this before earnings, not only are you controlling the amount of risk, you're giving yourself a very, very high probability of making money on those option contracts, okay? If you get a little more aggressive, you can even sell a put here before that move, as long as you're out before, even though, you know, I wouldn't do that because of that implied volatility spike, okay? Oh, but remember one thing, if you're selling options, 30, maybe 40 days or less to expiration. If you're buying, you want 90, 120 days. If you're buying leaps, if you're trading off the higher time frames, say the weekly or the monthly, and you're expecting to hold on to that stock a little longer, looking for a much bigger move, then you want to trade the leap contracts, okay? You want more time to expiration, okay? Now, as I mentioned, there's so much with options, so many different strategies. And what we've done is put together a course for you. If you go to tradingwins.com/May for the month of May, tradingwins.com/May, it'll take you to this page. And we've put together this package for you where you'll receive a 2.5-hour on-demand training course where I go through everything I did today in much greater detail, but we cover a lot more, and we get into all the other strategies that I showed you on that earlier slide. And I'm going to show you how to create a steady weekly income using credit spreads. That's one thing. The other thing is butterfly spreads. I really like butterfly spreads because, you know, aside from them being a little more complicated, the risk reward is so much in your favor. You can often find a trade where you're risking about $90 to make $1,000. And that's the real benefit here. And I'm going to teach you how to do that. Also, there are many times throughout the year where the market kind of trades flat. And during that time, there are a couple of different delta neutral strategies that you can use to still make money in the markets. And we'll teach you that. One of the more important parts of this class is the repair strategies. If you do get caught in a trade that goes against you, I'll show you a couple of different methods where you can repair it and make back most, if not all, of that loss. Okay. As a bonus, we'll throw in a 30-day membership to our Trading Wins Pro service. What that includes is nightly videos, 5 times a week. Every Sunday to Thursday, I'll send you videos after market close, recapping what happened that day in the market, where I think things are going, and that's where I share my trade ideas. Also, as a member, we get together with our members twice a week, Monday evenings and Thursday mornings. We have what we call live market chats. You'll get to come into our room, ask me any trading related question you like. Doesn't have to be on options, it can be on anything that you're struggling with. I'll try to help you out. Those sessions are recorded, so if you can't make it live, you'll get those as well. And every month we have a course of the month for our members at no extra charge, and you'll get an invitation to that and a recording of that as well. So you'll get all of this, the 2.5-hour on-demand video, a 30-day membership, which includes nightly videos, the 2 live market chats a week, and the course of the month over the next 30 days. All of this for $7. It's not a moneymaker for us. We're just trying to get you to see what we do here at Trading Wins. We think you'll enjoy and get a lot out of it. Again, the link is tradingwins.com/May. I am out of time, unfortunately. If there are any questions at all that you think of after the session, you can send me an email at info@tradingwins.com.